All right, so we're going to talk about chapter 22 here. So this is dealing with performance measurement and responsibility accounting. All right, so in large companies especially, when you're dealing with performance evaluation, um, certainly it's easier to uh, slice these small companies up into smaller units, usually called divisions, segments, or departments. Um, Now, as you get larger, you have to become more decentralized, meaning that the decisions are made out in the field by the managers close to the action, you might say, rather than top management in headquarters. So, the question is, well, if they're making decisions out in the field, how do we know they're making decisions that are in the best interest of the corporation, the company? How do we know that what decisions they're making are going to meet the objectives of the company? Now, when you look at these departments or divisions or whatever segments, these are broken down into three types of uh, what they call uh, centers. And so, depending on the type of center you have, if you're evaluating it, you're going to evaluate it different ways. I guess I'm trying to say, depending on the type of center you're evaluating. And so, for cost centers, here the managers over these centers are only uh, responsible for controlling their costs in that particular cost center. They're not responsible for any sort of revenue generation. And so, what would be a typical example of a cost center? Well, normally these are like administrative type departments, such as the accounting department, finance department, et cetera, et cetera, et cetera. Production department is not responsible for uh, revenues. And so the success of the manager of a cost center depends on how well they control costs within their department or whatever. Um, if you are a profit center, the manager of that profit center is responsible for not only generating revenues but controlling costs as well. And so they get evaluated on how well they generate income, which is the difference between the revenues generated and the costs incurred. Now, you could also have what's called an investment center, and this type of center deals with investing in capital assets, and so these managers are evaluated upon their success in how well they get a return on investing in those capital assets. Now, when you're evaluating managers, regardless of what type of center it is, you want to evaluate them on um, costs that they have the power to make decisions on. If they don't have the power to make a decision concerning a cost, then you shouldn't hold them responsible for that cost. And so what we do is we break these down into controllable versus non-controllable costs. Controllable costs are a cost that a manager has the power to determine or at least significantly affect the amount incurred. And so in a good performance evaluation program, controllable costs of a manager should be evaluated. Examples would be supplies used in the manager's department. Uncontrollable costs are not within the manager's control or influence and thus should not be part of their performance evaluation. And so, for instance, the department's the department manager shouldn't be evaluated uh, upon his salary cost because he has no control over that decision over what he's paid. And so when we're doing these responsibility accounting reports, we want those reports to be uh, collecting costs related to the responsibilities of individual managers. And if they're a profit center, it would be both related revenues and costs relating to the responsibility of individual managers. If it's an investment center, it would be the costs and returns related to that individual manager. And these need to be, like I said, evaluated based upon costs that are controllable by the manager. And so a good responsibility accounting system should meet those two objectives, that it's got to be related to the responsibility of the managers, and it's got to deal with items that are controllable by the manager. Now, depending on where you are in the corporate structure, um, determines what you control or don't control as far as costs and actually where you are on the in the corporate structure also depends or also determines the type of center you are. And so down there at the bottom, plant manager, beverage department, plant manager, food department, manager, service department, all those would be cost centers. And then above, you've got Vice President West Region, Vice President East Region. Not sure we have enough information on this, but, and plant manager, beverage department, plant manager, food department may actually be profit centers. So they may be responsible for uh, revenues and costs. Not sure. Service department, manager, service department. not going to be responsible for anything but costs. Vice President West Region, we have information here. If those two uh, well, of the three managers, let's assume that the plant manager beverage and plant manager food are uh, profit centers. And so the vice president of West Region may also be responsible for investments. So he may be uh, kind of a combination of profit centers as well as an investment center. And then, even if he's not an investment center, surely the executive vice president USA is going to be that. So, he's vice president USA is probably at least the investment center. And so, again, they all have certain costs that they're responsible for. And in this performance evaluation, they should only be evaluated on those costs that they have control over. Now, when you're when these performance reports concerning responsibility accounting are generated, the amount of detail varies according to the level of of the organization, and so the farther down in the organization you are, such as a department manager, you're probably going to receive a more detailed report, whereas the higher up you go, sales, store manager, vice president level, uh, the further you go up, the less detail you'll get. And so this kind of gives you an idea of the type of information that you're getting on uh, these responsibility accounting performance reports, depending on the level in the organization that you are. And so if you notice, starting at the bottom, you've got the plant manager of the beverage department. He has his information here. And notice this only deals with costs, not revenues. So apparently the plant manager of the beverage department is a cost center. And so he's only responsible for costs. And so what you're looking at is for July, he's got a report that shows his budgeted amount and comparing it with the actual amount incurred. And then the difference, depending on whether the actual amount is over or under budgeted amount, determines whether or not this manager is over or under budget. In this case, overall, he's under budget, or he's actually over budget. He's spent more than he's been budgeted for direct materials, direct labor, and overhead, primarily due, well, all of it's due to direct materials. Direct materials, actual is 52,500, budgeted is 51,600, and so that makes up all of the amount that makes him over budget. The other two, direct labor and overhead, are under budget. And so, is this bad? Well, maybe. I don't know. We would have to look and determine what has caused the plant manager to spend more in direct materials than budgeted. Maybe it's due to something that's out of his control, such as shortages in by his supplier. Maybe his supplier's having trouble getting things. Maybe raw materials are costing more or something. So it would. We don't know how bad it is until we do some more research. and find out why that cost is more. But notice that when you go up in the chain to the next level, Vice President West Region, he has all three departments as well as, and again, it's listed under controllable costs, the salaries of department managers, his portion of depreciation, and his portion of, or not sure how the insurance is allocated. It may be a direct cost that he controls. Either way, it's either an allocation made by the headquarters or something that is paid for out of his or her budget. But note that the bottom line number for beverage department is simply a line item in his controllable costs. Now notice as you go up to the next level, the executive vice president, it shows the bottom line figure for West Region along with all of his other controllable costs, the East Region and office costs and some other stuff.
Below are the annual budgeted and actual costs for the Western Region's manufacturing plant of Rios Company. The plant has two operating departments, motorcycle and ATV. The plant manager is responsible for all of the plant's costs, other than her own salary. Each operating department has a manager who is responsible for that department's direct materials, direct labor, and overhead costs. Prepare responsibility accounting reports for the plant manager and each operating department manager.
Direct expenses
All
are
costs, both budgeted and actual, must be included in the responsibility accounting performance report of the person directly responsible for control of the cost. The direct materials, direct labor, and overhead are controlled by the individual department manager. The budgeted and actual direct materials, direct labor, and overhead for the motorcycle department are reported on the motorcycle department manager's performance report, and the budgeted and actual direct materials, direct labor, and overhead for the ATV department are reported on the ATV department manager's performance report. Since each department manager is only responsible for a single department, their performance report only reports one department's costs. The remaining costs, department manager's salaries, and the rent and utilities are the responsibility of the plant manager. Since she's responsible for two departments, her responsibility report includes the budgeted and actual costs for both departments. The next step is to compare the budgeted and actual amounts. The motorcycle department manager's actual costs for direct materials, direct labor, and overhead are all more than budgeted, a total of $7,600 over budget. The ATV department manager's actual costs for direct materials, direct labor, and overhead are all less than budgeted, a total of $10,900 under budget. The actual costs of the department manager's salaries and the rent and utilities are compared to the budgeted amounts. The plant manager is $1,700 under budget for the items directly under her control. Since the plant manager is responsible for all plant costs other than her own salary, the budgeted and actual results for each department are rolled up into her responsibility accounting performance report. All $655,000 of budgeted costs and all $650,000 of actual costs are ultimately reported on the responsibility accounting performance report of the plant manager. She's $5,000 under budget overall.
Now, these service departments these are departments that service the operating departments, such as sales and production. And so their costs have to be allocated to the operating departments. And so these are costs that are shared indirect expenses that support the activity of two or more production departments. And again, it could be production or sales, but same difference. And so here again, you're going to have such things as office expenses, personnel expenses, payroll expenses, purchasing costs, maintenance expenses. And so you see some common allocation bases for those types of expenses. So if you have a maintenance department that services several different production areas, you might use floor space occupied of each of those production areas as your base. Purchasing department, purchasing costs might allocate their costs based upon the number of purchase orders by each production department, and so on. So here we have an example. Classic Jewelry pays its janitorial service $800 per month to clean its store. Management allocates this cost to its three departments according to floor space each occupies. And so here we have total of 4,000 square feet. Jewelry takes up 2,400 square feet, or 60% of the total square feet. Watch repair takes up 600, or 15%. And china and silver takes up 1,000, or 25%. And so you simply take the percentage of square feet of each and multiply that times the total cost of 800, and there you come up with the allocated cost to each operating department. Here, these are not production departments necessarily in the literal sense, but they are producing, I guess, revenues. So from that sense, it is a producing or a production department, or these are production departments. And so we can prepare departmental income statements and contribution reports. And so let's see how that's done. So first thing we want to do is accumulate the revenues and direct expenses by each department. We also want to collect information on total indirect expenses. Next thing we want to do is allocate the indirect expenses across both service and operating departments. And then we want to allocate service department expenses to the operating departments. And then from there we can prepare our departmental income statements for the operating departments. All right, so here we have our example in the book. So we've got all our expenses here. Got our direct expenses. We've got our service departments there on the left. We've got our operating departments in the three columns to the right. So we got all our expenses there for each of those departments, service and operating. Then to the left down there below, we've got our indirect expenses. So we've got direct expenses of all 5 departments, service and operating, and then our total indirect expenses. So we've done step 1 here. Step 2, we want to take and allocate our indirect costs. And so here, let's see what we're doing. All right, so we've got general office department total costs of $15,300, and the allocation base we're using to allocate this $15,300 for the general office department is based upon total sales of each of our operating departments: hardware, houseware, and appliances. And so essentially what you're going to do is you're going to take the 15,600, well, let's see. Well, you're going to take the numbers from the prior sales: 119,500, 71,500 in housewares, and 47,800. You're going to take those, add them up, and divide by 3. Well, no, you're not. You're going to take those 3 numbers of sales, total sales, and then you're going to figure out the percentage of sales, total sales for each. And so, for example, for example, 119,500 plus 71,700 plus 47,800 equals 239,000. And so you're going to take that 239,000 as your total. And so, for instance, the 119,500, you're going to divide that into 239,000, and that's going to be 50%. So they're going to get allocated 50% of that total of 15,300, and you see that's exactly what's going on. 7650 is exactly 50% of 15,300, and then whatever percentage housewares and appliances are revenue-wise when compared with the total sales is what they get as well. Now the next one, purchasing department, this is based upon purchase orders. So if we go back, and I guess we have to go look at the book to see what information we have. Let's see. Yeah, you have to go to page 1008, which is in the appendix. If you look at the very top, it shows the number of purchase orders to be 985, and you have a breakdown of the number of purchase orders in each. So there is your 3880 is the allocated cost to hardware, and 2630 to housewares, and 3190 to appliances. So that's how they allocated that. It was based upon the number of purchase orders, which like the book says in red there on page 995, you have to go to the appendix for the detailed calculations. So that's how they allocated the service departments to these operating departments. And so once the costs of the service departments are allocated to the operating departments, you can create these departmental income statements for the three operating departments, as well as a combined income statement for all three, which we see here in step 4. Now you can also show an income statement showing departmental contribution to overhead, which is going to be departmental revenue minus direct expenses. And so we see in example 2212 on page 996 an example of this. Now, what is departmental contribution and how is it used? Well, it's used to evaluate departmental performance. Note the good thing about it is it's not a function of arbitrary allocations of indirect expenses. And so it might be just another indication, and maybe a better indication, of how well an operating department is operating or performing. Now, you want the departmental contribution to overhead to be positive. If it's a negative number, it might be that this operating department is a good candidate for elimination. Just get rid of them because they're not contributing to overhead, these indirect expenses. And so here we have our example of a departmental contribution to overhead income statement for each of these operating departments, and note that all three of them have positive departmental contribution to overhead numbers. Now, investment center managers are evaluated using performance measures that combine income and assets. And so performance measures are things such as return on investment, residual income, profit margin, and investment turnover. Now, these are some of the things that I think we saw in, I think it was Chapter 13, was it not? Analysis of financial statements. So you should be familiar with some of these numbers already. So return on investment is the investment center income divided into the investment center average invested assets. A little different from ROI based upon a whole organization, but it's the same concept. And so here you could have a comparison of two competing divisions. So here, note that one company earned more in net income, but yet their return on investment was less than the other. And so this is an indication where pure dollar amounts don't tell the whole story And so trying to get things down to a common ratio or percentage helps compare different divisions that may actually be different sizes. Might have residual income, which is the investment center net income minus a target investment center net income. And so here, the target investment center net income is based upon, I believe, a percentage of return on assets. Or I think what this is a percentage of revenues. So they're targeting 8% of certain revenues as their net income. And last but not least, let's talk about non-financial performance evaluation. And so you can have other things involved in besides the financial numbers in your performance evaluation. So such things as customer surveys, what the customers think of us, certainly financials, and some of these other things that may be performance indicators. Anyway, that's it for chapter 22.